Welcome in, everybody. Opportunity to talk to David Bahnsen Group, sponsor of Two Way Tonight, and a great friend of Two Way and all of our programs. And delighted to have David back with us to talk about what's going on. David, first of all, just remind people, because we've got some new people on IC, just remind people where your expertise on the economy comes from and what the Bahnsen Group does.
So the Bahnsen Group is coincidentally, Mark, named after my last name, is the private wealth management firm that I started 10 years ago after leaving Morgan Stanley, where I had been a senior portfolio manager and managing director for many years. And so we are a national private wealth firm. I'm sitting right now in our offices in Manhattan. We have offices in 10 cities around the country. 80 people who work for us, and we manage over $7 billion of client assets. And that is our story.
Okay. What is this period we're in now with the uncertainty caused by the tariffs, uncertainty caused by Doge, uncertainty caused by a lack of clarity about when the reconciliation bill will pass and what will be in it? Is there a period you compare this to in terms of the uncertainty caused for individuals, for families, for communities, for state and local government, for businesses?
Yeah, that's a good question, because I think there's so many things in the economy that rhyme but don't repeat. And I am one who very rarely would ever say that something is unprecedented, because most things have a precedent, but that doesn't mean that they're identical to prior events. The uncertainty that was unleashed in 2018 with tariffs is different. There's obviously similarities, but I believe that there's probably more important things that are different in 2025 than 2018. But as far as the general question of economic uncertainty that impacts consumer decisions, or more importantly to me, and impacts business and production decisions, there's hundreds of examples of various extrinsic contributors to uncertainty. It's not very common that the cause is necessarily coming directly from policymakers and on purpose, but nevertheless, we've certainly dealt with various periods of uncertainty. A lot of that is because an economy is intrinsically uncertain. There's a certain fragility to 330 million people doing trillions of transactions every day. And yet the uniqueness of this is on the policy front, the intent of the administration, and those trying to compare it to 2018.
If you'd like to get a question for David, please raise your hand. We're going to get to you shortly. I see a couple hands up, but I know more of you have questions than that based on preliminary communication I had with some of you. So if you'd like to ask David a question on the economy, macro, micro, you want him to look at your portfolio by sharing the screen, raise your hand and we'll get to you in just a minute. I know you're a skeptic of the tariff policy, and I put policy in air quotes because it's a little more chaotic than normal policy. Some people who I respect have written op-ed pieces recently. Mr. Lutnick, the Commerce Secretary, went on the All In podcast and did a kind of an extended riff on the defense of the tariffs. Is there anything about what's been said about the tariff policy recently that makes you feel like it is a good idea?
No, the thing that I suppose I take some solace in is that there's more and more being said that makes me think it isn't real policy. I'm very much in the camp that we are not getting on April 2nd an academic white paper adopted into administration policy with a blueprint for execution. I think you are going to see a carve out here, a carve out there. This company is in, this company's out, this sector's in, and this sector's out. And it could change on April 3rd. And so I'm not really convinced that we are getting a sort of comprehensive plan for substantial and universal protective tariffs. I expect you'll get certain announcements. A lot of this will go to a place that meets the president's objectives, which are headlines that indicate victories for the United States. Hearing some country or some company announce onshoring of certain manufacturing or intent to invest, I think those things will slowly whittle away at actual enforcement of tariffs. And along the way, there will be certain tariffs implemented. They will come at a cost, but the trade-offs will be very difficult to measure because it is already quite clear that there's going to be a gazillion exemptions. And that is something that is very much in common with 2018.
There's certain people who've been in the executive branch during my career who my sources in the private sector look at and say, if James Baker is in the government as chief of staff or treasury secretary, or if Bob Rubin is head of the National Economic Council or treasury secretary, it's going to be okay. There may be some policies we disagree with in the private sector, but these guys, hand on the tiller, we're pretty confident. Is that true of Scott Bessent or Kevin Hassett or Mr. Lutnick? Are there people in the administration now who are giving that sense of confidence that whatever twists and turns there are with tariffs and anything else, it's going to be okay?
Mark, I want to speak very candidly about what I believe is going on here. And I haven't shared this a lot. I was in the Treasury Department last week, and I think Secretary Bessent is someone who could evoke a lot of confidence in markets. I think that the messaging was off for a few weeks, where I believe that his intent is far more focused on renewing, extending TCJA, the Trump tax cuts of 2017, and additional tax reform that is on the administration's agenda than they have messaged. And I think he got pulled into a messaging issue on tariffs that I believe was counterproductive. And from my talks with them, I think they believe it was. But you, at the end of your question, lumped in Secretary Lutnick. And my view is that markets are more sympathetic to where Secretary Bessent is coming from. And that doesn't mean everything he says that people like myself are going to agree with, but I think that they trust Secretary Bessent to have an understanding of impact to the dollar, impact to global trade, impact to productivity. And I do believe that there's a little divide in the administration between Treasury and Commerce. Now, you could say this is a compliment because they haven't let it get out much. I don't think there's a lot of headlines. There was some noise back before the nomination took place in November, where you may recall that Lutnick was chairing the transition committee, made a play to get the Treasury job, and Elon Musk tweeted on a Saturday night, "We need to go with Lutnick. Bessent is too much status quo." And the president didn't do that. He stuck with his intent, which was Secretary Bessent. But no, I don't think Commerce and Treasury are totally aligned here. But the April 2nd tariff announcements are in the portfolio of Commerce. The U.S. Trade Representative Jameson Greer, former protege of Bob Lighthizer, reports to Secretary Lutnick. Markets, I believe, would feel better if Bessent was more in charge. Lutnick is an incredibly charismatic guy, but I think that there is a certain chaos in the messaging that I continue to wonder if it's what POTUS wants. That not so much from a palace intrigue standpoint, there isn't a lot of ability to price in or know exactly what's going to happen. And that sort of day-by-day change in messaging is part of the reason.
Okay, really interesting. All right, let's go to your questions. You'll unmute, you'll tell folks where you're calling from, and question for David. Jack, welcome in. Go ahead.
David, it's a pleasure to talk with you. It seems to me with some of these tariffs, so much is performance for political and other reasons, which I find very troubling, because fundamentally, I don't think those jobs we lost overseas went there for a reason. My wife could buy maybe $1,000 kitchen table we could hand to our grandchildren, and made in North Carolina. It was a beautiful piece of furniture. But the American consumer has voted and said they can take a table built in Asia for paying a guy $10 a day and buy it at Walmart. That's where we've gone, and I don't see us able to get back where we came from without raising prices dramatically.
I think that is one of the most substantial arguments against protective tariffs. But I would even add to that, that not only is it pitting certain potential domestic manufacturing against the consumer, by the way, all of whom the people employed in domestic manufacturing are also consumers, but I also believe it's ignoring those who work as domestic manufacturers that are engaged in the business of exporting. And it ignores those who are working in the United States in services. So if you are to make the point, which I do not concede, that there is some degree of benefit to domestic manufacturing as a result of protective tariffs, and again, I don't concede that point, but if I did, you cannot concede that it doesn't come at a substantial cost. So you and I are in wholehearted agreement. If Canada cuts down on tourism 10 to 20%, the services industry employs 17 million people in the United States. Food, beverage, hospitality. So we are talking about shifting, not net addition. We're talking about reshuffling a deck, potentially, but there is no net addition in the benefit. And I think that economic point gets missed in this conversation time and time again.
Jack, thank you. Go ahead.
Thank you.
Okay, thank you, Jack. Appreciate it. Mike, welcome in. Question for David Bahnsen. After you unmute, tell folks where you are.
Hi, good morning. Thank you for taking my call. I am in Charlotte, North Carolina. I had a question on tariffs. If we don't have tariffs, say, in the automobile industry, how does the United States, Europe, Canada, Japan, and Korea maintain their car industries from the threat from China? Some of these countries have 100% tariffs on Chinese cars. We made a decision as a country to save the automobile industry in 2009 or 2010 for a lot of very good reasons, strategic reasons, other economic reasons, there's also strategic reasons. If we don't have a strong industrial base, we don't have a defense industry. I don't think the defense industry can survive without a broader industrial base. How would you address that?
Mike, thank you. David.
Yeah, I very much agree that we need a strong industrial base, and the disagreement comes to the tactics to enforce and fortify an industrial base. What is happening competitively with China and Europe is not at the heart of U.S. taxes on U.S. importers that are largely borne by U.S. automakers that are exporting some of the part manufacturing. There are different tariffs from different countries on different lines. The F-150 issue is a really good example where there's different tariffs on trucks and cars and so forth. The weave of this is not good. And by the way, I'll have to continue going back to who is paying the tariffs, because even the subject of reciprocity, which is being used to say we need tariffs because the Europeans are tariffing us on some of our car imports, what they are doing is charging their importers. And that is meant to be competitively advantageous to them and against us, but it is a cost being borne by their importers and consumers. And I find it to be a non sequitur to say that we will now tax our people to punish them for taxing their people. Be that as it may, your broader question is very important. How do you go about supporting a wider U.S. industrial base? My question is, why are we manufacturing more than we've ever manufactured domestically if we're eroding that manufacturing or industrial base? And of course, the issue is largely not about trade agreements, but technology. We just simply are manufacturing a lot more with less manpower. And I don't believe there is a solution to that. It's a sign of greater productivity. All things being equal, I would love to have more factories onshore, but I'd love to have a labor force with higher participation. So I think we have cultural issues that are lower hanging fruit to address than we do the nature of trade agreements. Certainly the defense and aerospace industry, there is a substantial desire for these things to be being made domestically. The issues, of course, with the automobile industry in 2009 are not related to trade deals. They came, as a matter of fact, after 20 years of significant amount of protectionism to try to benefit Detroit from the competition of Japan and Germany. And in reality, they were making better cars with higher customer satisfaction, and the US auto industry was plagued with an embedded cost structure that led to its financial demise. And so right now, going forward, I have to answer the same way I would about anything. How do we compete with greater innovation, greater investment, greater incentive for investment, greater tax and regulatory relief relative to competitors? And I think that done on an across-the-board basis is far lower hanging fruit than select and oftentimes crony tariffs.
Thank you.
Yes, sir.
Great. Thank you. Janice, welcome in. Question for David.
Yes, thank you so much for taking my question and for this program. I feel like it's such an education. Every time, Mark, you host anything, I feel like my learning level has so greatly increased. So deeply grateful. David, so appreciative of being able to track your work and dive into that. Again, I'm a total novice with tariffs. My question is, fairness, like around the world, what to do with the tariffs that other countries, so it's supposed to be free trade, right? But is there a concern about somehow leveling out the tariffs that are put upon us and create more of a fairness instead of maybe more the objective of getting ahead and making America wealthy, that line, but more just leveling the field with honest back and forth treating each other with tariffs and goods and trade?
That's a great question, and I have very strong opinions about it. I think that you frame the question exactly right, where you're not presenting unfairness as a byproduct of one country selling us more than we sell them. You're referring to if they charge a certain tax on imports from us, then how do we deal with the unfairness of us not charging that tax on them? And I have an answer for that, but it's a different issue than what is often presented as unfairness. I categorically reject the idea that there is anything unfair about us buying more from another country than they buy from us. That, in fact, it is a sign of how wealthy as a country we are. And that the only times we run a trade surplus is when we're in recession. And that the countries that have trade surpluses, by and large, are not countries we're trying to emulate economically. The fact of the matter is that buying more from someone else is not in and of itself unfair or even inherently problematic. And there are various economic reasons why it's often a wonderful thing. It makes us richer as a country and enhances our quality of life. But your point on fairness is, what about when a country is representing some sort of unfair deal? And this was the argument largely around China in 2018. I have to answer philosophically, because it's the way I was raised, that there's first principles at play. And the question I always have is, who is supposed to determine what's fair and unfair? You and I every day transact in the marketplace. And if I go to a place to get my hair cut and they want to charge a certain tax or service fee on that, and I don't want to pay it, and there's another place that doesn't, I get to choose. And I understand that the analogy is not exactly the same, but there is a principle at play that in a market economy, we believe the actors in a transaction are going to determine what's fair and unfair. And what has historically not been a conservative orthodoxy is the idea that 1600 Pennsylvania Avenue is the arbiter of fairness. Now, at a high level, people can just say, you can say all that Milton Friedman stuff all you want, but if they're charging a 50% tariff and we're not, that's unfair. I take that superficially, but you have to also wonder what other factors go into that. But then I still come down to what I said to the prior individual who asked the question. I believe it to be a non sequitur to say we're going to solve for the unfairness of what that country is doing to their consumers, that we're going to now do the same to our consumers. In other words, as much as I love the idea of evening a playing field, leveling a playing field, trying to find some definition of fairness, even if I have to bite a bullet and pretend I believe that the executive branch of government gets to determine fairness in economic transactions, I still don't accept that we're creating fairness by punishing other actors in our economy. And that is ultimately what I believe they do. So I don't mean to wax and wane so much philosophically on tariffs. There's plenty of reasonable people that disagree. And the largest issue here is that, to the extent much of this has been presented by Secretary Bahnsen and by President Trump himself as a means to an end of getting to a place of less tariff, not more, better negotiations on other domestic policy objectives, the fentanyl thing that was in the headlines over a month ago. If that's where we were headed here, I don't have an issue. But if we were talking about leaving more permanent impediments to trade on the table, whether in the name of fairness or protectionism, then I do disagree.
Janice,
Thank you.
Thank you, Janice. Thank you for being part of this. David, in general, with the uncertainty we're in right now, with the not clear when and if the tax cuts will pass and what they'll be like with tariffs, with Doge, what's the general philosophical posture you have towards investment now?
I generally believe that what is most relevant to economic growth is not usually the headline issue in public policy, and certainly not in partisan politics. So like in an election year, when who's going to win, who's going to lose is thought of as a big driver of public equity markets, I generally find that's not been true, and historically it bears it out. And this is a bipartisan thing. It's naturally embedded in us, but it's gotten way worse in recent years, where it's incomprehensible to us that someone can be president we don't like and markets can go up, and someone can be president we do and markets can go down. But the fact of the matter is that markets generally go up regardless of who's president, because markets generally go up. And so you've had very robust returns under the last 3 Democrat presidents, and you've had generally very robust returns under the Trump administration, Reagan administration. Bush Jr. got very bad luck in terms of the beginning of the stock market when he first came into office in 9/11 and the minor recession, and then obviously the way things ended with the financial crisis. But my conservative friends are usually, and of course I'm a lifetime National Review conservative, but they're generally blown away when I say that the stock market was up 8 out of 8 years under President Obama. So I put less credence in what's going to happen in markets, but in the very short term, there is a lot of additional noise right now. And I believe there's a level at which public markets would require President Trump to pivot, find an off-ramp. He's one of the best I've ever seen at finding an off-ramp and claiming victory. And I have no doubt that he would do that again in this case, but probably it would be a little too late, that there'd be some damage already done. The issue so far, Mark, is the S&P dropped 10%, and then it's come back a few percent, and that just happens every year without tariffs, without something that either Trump or Biden or whoever you like or don't like is there. Markets just do that almost every year. So 10 was not enough to chasten the president here. I think 20 on the downside probably would be. But we started off the year with the S&P 500 trading 23 times earnings. When President Trump took office in 2017, it was trading at 16 times earnings. So you had a far more top-heavy market, more dependent on NVIDIA and Apple and Microsoft. You had a very high valuation across the stock market, a very high valuation in big tech and Mag 7. And if we were not dealing with trade war talk right now, we could very well still be in the same place with markets. So my long answer to your question is I'm thinking about investment markets the way I always would. Where is there good value? What is the price I want to pay? What is the thesis I'm buying? And what are the risks to all that? That process has to play out. And trade and tariffs are only one piece of a much larger picture.
Thank you for that. Warren, welcome in. Thank you for joining. Good to see you. Tell folks where you are and what's on your mind.
Thanks a lot, Mark. Can you hear me?
Yes, sir.
Yeah, I was in New York last week and went to an economic club lunch featuring John Gray, who the CEO of the Blackstone Group, his base case for the U.S. economy is basically slower growth, 1.7 or so, and higher prices. Larry Summers, on the other hand, a couple of weeks ago was talking about maybe 50% chance of recession. I wondered, David, what your general outlook was for the base case for the U.S. economy.
Yeah, it's funny. The 1.7 case that John Gray makes is very similar to the sort of stagnant growth thesis that Larry Summers had a long time. That's pretty much my view as well. It doesn't have to be sub 2%, but I think it likely will be. But that's not a thesis that either Summers or Gray, who are both neo-Keynesians, or even myself, who's much more of a supply sider, would have short term necessarily. It's a longer term belief. And for me, it's just rooted to the excessive indebtedness that the country has, that if government spending is going to take out 25% of GDP versus 16 or 17% of GDP that we're used to, I think that's an awful lot of economic resources that are allocated to a less productive part of the economy than the private sector, where I expect there to be more robust activity. And so we have been in, before COVID, from financial crisis to COVID, basically right where John Gray was talking about. 1.7, 1.8 was the real GDP growth, net of inflation, per year, all through the Obama administration. President Trump had 1 year where it hit 3% right after his tax cuts and so forth. And COVID, obviously, both the COVID moment and contraction and then the recovery created a couple outliers that throw some of it off. But on a trend line basis, I am in agreement that we are looking at a sustained period of subpar real economic growth. I was at the Economic Club in New York with Jay Powell last year. It was the first time ever I had heard a Fed chair say we're hoping to get to 2% real GDP growth in our expectations. The United States functioned at 3.1% real GDP growth for 70 years, from World War II to the financial crisis. And so everyone is expected, it's baked in the cake now that we expect subpar real economic growth going forward. The disagreements are somewhat as to what has caused it or what to do about it. The part where I would disagree is on prices being higher permanently. I believe the data is unbelievably clear that we face higher prices as a result of policy failures in housing, healthcare, and higher education, but that there has been downward pressure on goods, and services are highly skewed by the housing data, the cost of shelter. But that is a supply side issue. So it's fixable.
Warren, thank you. Thank you
Thank
for
you.
that. Appreciate it. Good to see you. Alex, welcome in. Tell folks who don't know where you are, what's on your mind for David Bahnsen, please.
Hi, is that me? Yeah.
Yes, ma'am.
I'm in Connecticut, and I just had two quick questions, and I'll try and be quick about it. My first is, I think we've started to realize that the GDP measurement and also the stock market is not a great indicator of exactly the health of the economy right now. People are trying to look for other tools to actually measure if the economy is healthy. Those tools seem to be only measuring if the top 10% of our society is doing well. So are you looking at any other types of measures to try and get a more accurate view of the health of the economy?
But first of all, GDP and the stock market as a measurement of the economy are two different things and have their own different strengths and weaknesses. The stock market should never be thought of as a measurement of the current economy. A forward look on expectations for profits. That's what markets are weighing. That's what they're supposed to be weighing. And I believe that the stock market is a wonderful forward measurement of expectations of corporate profits. In 2009, March of 2009 to be precise, the Dow, S&P, and NASDAQ began a violent recovery, and the economy was in the doldrums all of 2009 and all of 2010. And you were still dealing with double-digit unemployment when President Obama faced his midterms in 2010. The stock market had been up substantially. But markets are not supposed to be measuring last month's jobs data. They're measuring expectations on a go-forward basis. So I very much distinguish between the economy and the market. Now, I disagree a little more on the GDP side in that I don't think GDP is measuring what's happening to the top 10%. But if one wanted to just simply say, how are things going for the bottom 50%, we could easily do that by measuring real wages. Because the overall economy is a combination of consumption, production, and the way in which GDP is measured. And a lot of people will say it's an inadequate measurement. And what I always say is that's fine, but it's useful relative to what it has been. Whatever GDP is this year tells you something about what GDP was last year, the year before, the decade before, et cetera. But gross output, and myself as a supply sider, what I care about is production of goods and services. That to me is what creates economic growth opportunity. But if one says, yeah, that still doesn't tell me how the guy down the street is doing. I want to know how wage earners are doing that don't have a lot of assets like you do, David. So the stock market, real estate, those things we take out. But there's no better measurement than real wages. And now even in real wages, you could say, and all I mean by that is the level of growth of incomes adjusted for inflation. At the end of the day, I think that GDP captures a lot of the activity with consumers. I think production is a cause and consumption is an effect, but that's an economic belief. But as far as a measurement of how different people play a different role in society are doing, there's so many data points available. The question is what to do when those data points seem to be telling a different story. That doesn't happen very often. But I think that if someone were to say to me, do you think our job market is healthy? I would say at 4% unemployment, I believe that the BLS number gives me a pretty good data. The weekly jobless claims gave me very good data. as to how many people who want a job have one. That looks like a pretty good number. And year over year, wages are growing more than prices. So far, so good. But then if I bring up the labor participation force, I have to wonder why there are so many people that remove themselves from the job force. That strikes me as more of a cultural metric than an economic one, a cultural metric that has profound economic ramifications. But it's measuring two different things. One is measuring jobs available and one is measuring workers available. So I try my best to get all of the data points and form narratives around the sum of parts here.
Alex, second question.
My second question is about housing. I wanted to get your take on tariffs are one thing, but I think the other big issue in our society is housing. People are feeling like they can't enter the market. And then also for those of us that do have housing, we've gotten stuck in this. I got in at 3% mortgage rate, 30-year mortgage rate, and then it went to 7%. You're stuck in the house that you bought 10 years ago. And so maybe you're adding on an addition. You're trying to improve what you have because it doesn't make sense to buy a new house or upgrade. And now we're facing this kind of crisis where we want people to buy more housing and have that availability, but also the people who already have housing are looking at a market crash where most of their kind of economics are tied up in it. So what is your view on the housing market, and how do you see the effects of the higher going lower, the lower maybe getting access to the market, and what does that look like in the next 2 years? Is it going to change? Is Trump's policies going to build housing in these areas that need it, or are we looking at more higher real estate prices for forever?
I don't know what a president can do to positively benefit new supply. On the margin, there's a bully pulpit, but the vast majority of what is a supply side disaster in housing is state and local. And it's something at my own Capitol Record podcast that I host at National Review, I've talked about a lot, that it starts with citizens going to local city council meetings to complain about new house development and this NIMBYism that is a bipartisan problem. But then it goes all the way up to certain states in particular with really obnoxious impediments at a regulatory level to getting new housing built, and both in the zoning side, environmental, et cetera. First of all, your diagnosis is exactly right, that we largely have people that have had good price appreciation that are in a position to buy a new home, but feel that they want to keep their 3% mortgage versus going and obtaining a new 7% one. And all I can tell you is that there are a lot of people who will end up trading, and they will not be waiting for mortgages to go back down to 3. I pray to God they never go back to 3. 3 creates distorted economic activity. It's fantasy land. There is no bank who should be lending people money for 30 years at 3%. It is stimulative and artificially, but it is not in any real world economic reality. Do I think someone with a 3% mortgage will trade for a 5%? I do. 5.25, maybe 5.5, less so. There's some number that the Fed is trying to find where they can bring the long end of the curve down to a point that mortgage rates adjust and it starts to clear the market. But in the meantime, I'm more worried about things that the administration can do to hurt than I am help. I would love to see reform with Fannie and Freddie, and all I mean by reform is get it off the Treasury Department balance sheet and some form of privatization. It's been 17 years since they put it in conservatorship. There is a $250 billion preferred buildup. That backstop of the taxpayers needs to go away, and there are all kinds of solutions to properly capitalize Fannie and Freddie and privatize. But this issue of like lumber tariffs, for example, you're not going to get new home construction if lumber prices go up 30%. So the lowest hanging fruit is state and local. You have to get more housing built. And then there are other things on the margin that impact it. But that is a huge agenda of the Fed, that they need to clear the housing market. It has not bled into the real economy yet, but it's 17% of GDP. They're very worried that adjacent things will end up starting to lag because we are at such a 30-year lull in housing activity. I don't care much what the sticker price is on someone's primary residence. I didn't care in the years building up to financial crisis, and I don't care now. I view my home as where I live with my family. I know some people want to view it as a bank account, there's a problem from a personal financial planning standpoint with that is it only becomes a bank account if you sell it. And then if you sell it, you're either going to be homeless or you have to go buy something else, in which case you're selling one thing high and buying something else high. So I have a little less concern about the asset price on primary residence. But fundamentally, I believe that what we need is more housing because I think we have an affordability issue. And I'm less worried about people in their 60s maintaining an elevated level of equity than I am people in their 20s and 30s that have good income and have good savings and can't afford to buy a home. I think that's a major problem. By the way, far more real life kitchen table than tariffs. And yet housing is barely ever discussed coherently in the public square.
Alex, thank you. Appreciate you being part of this.
Thank you, guys.
David, two follow-ups on questions. One is, do you think the right policy is for Fannie and Freddie to have no connection to the federal government?
I do, but I also believe the way in which you decouple from the federal government is very important. So it was one of my favorite titles I ever came up with for a podcast was we had for years and years what was called the implicit guarantee, where Fannie and Freddie were not explicitly backing all the loans that had been created, but it was implicit in the charter that created them by Congress. And then at the point of 2008, September 8th, 2008, it became an explicit guarantee. What you can't do is go from explicit guarantee and conservatorship to an implicit guarantee and privatization. You have to have an explicit non-guarantee. Now, people say, well, that's going to increase the cost of borrowing. If there is a very well capitalized, or not even a monopoly or duopoly, but a highly competitive place in which well-capitalized companies out of the pref equity that exists in Fannie Freddie is there to backstop loans so banks can sell good loans to Fannie Freddie and various competitors, there is no reason that you need a government guarantee. The only reason you need a government guarantee is if you're going to have a wave of defaults. And Fannie Freddie shouldn't have had a wave of defaults either. These are supposed to be the most conforming loans in terms of underlying loan quality imaginable. So the capitalization that we've built up, this can be done. There's plenty of good proposals. You recall Mark Calibra, who was President Trump's FHFA director in the first term. He had plenty of very thoughtful policy ideas as to how this could be done. It isn't a big issue for President Trump. It's not a high priority for him. I happen to believe Secretary Bahnsen has some plans here, but it will probably be in the second half of the administration.
Yep, I agree with that. Who would be their regulator?
That it would probably be a combination Treasury, Fed. It would depend on the way it's structured. There's already HUD, there's already Fed, there's already Treasury. There's a way to consolidate that to do it quite coherently.
And I'm, as a 10th Amendment person, I'm all for the governors dealing with this. If you were the economic advisor to the governor of, say, California, where you spend a lot of time, what are things states can do to make housing more available, more affordable?
We had some tragic fires that everybody heard about in California a few months ago. And I heard the governor of California on, I think it was Meet the Press that weekend, say that he had a great idea for how we could get houses built real quickly and get back up and running in our recovery. And it was by suspending SECA and by giving people zoning and permitting and a lot of regulatory relief. And I thought, what a brilliant idea. And I'm in favor of it, even if there weren't fires.
Yeah. Okay. That would do a lot to increase supply. I'm not sure it would solve.
And New York is in the same exact boat. My primary residence here. And so I between California and New York, I get a chance to see a lot of policy issues. But again, it's sort of cliche. I don't want to only go to Texas and Florida, North Carolina, Indiana. There's a lot of states that have done this well. Utah, you can get houses built and policymakers need to get out of the way.
Yeah. Craig, welcome and thank you, David. Craig, welcome and tell folks who don't know where you are. Question for David Bahnsen.
I am in the greater Bedminster area, actually, New Jersey. So if you ever need a morning meeting discussion of weather on the golf course, I'll be happy to tell you.
Thank you, sir.
David, I agree completely with the exit of Fannie and Freddie from the business. And while you're talking about that, since I do think that the government is unnecessarily involved with the housing market, by having the 401k laws the way they're written, does that not enhance all retirees' investment in the market by way of tax avoidance, and therefore further complicate the relationship between the government and the citizens by way of the financial markets.
I missed something in between. How do we go from the government in housing to retiree tax avoidance? I think you said something that clicked out for a second.
Because I think a lot of the reason of housing is the tax deductibility of the interest
Oh,
is a cause for a lot of
yeah.
investment there. This is something I've got a big bugaboo towards. It wasn't the reason why I'm calling in, but it's something that you struck me because I was like, this man is smart. If he wants that out, anyway.
Yeah, no,
I
look,
have-
I'm against the mortgage interest deduction, but I don't think it's a big cause of why people
Okay.
own homes. I think people own homes because they want the stability of a place to live with their family. I'm against it because I think that the government should not use the tax code to pick winners and losers, and there's no reason to favor a person who pays a bank to borrow money over a renter in the tax code. But on the margin, when you had an unlimited state and local tax deduction and a mortgage interest, it was on up to $1 million borrowed money, which $1 million used to cover a lot of people. It covers a lot less now. Plus, it's come down to 750,000, and you're only deducting up to 10,000 to state and local. So the distortion that existed in favoring home ownership in the tax code was far worse 7 years ago than it is now. But yeah, fundamentally, I'm a purist on this. I own 4 homes. I don't believe I should get a tax deduction on any mortgage interest.
Nor do you believe that Californians and New Yorkers should be able to deduct the cost of their state and local taxes, even though you benefit from that quite a bit.
That's right. I'm one of the people who was most favorable of the President Trump tax cuts in 2017. I hosted Secretary Mnuchin and Ivanka Trump in my offices in Newport Beach for a client event the week before the TCJA passed. And I am one of the people I know that had my taxes go up the most as a byproduct of it all. So this is, again, more philosophical. At the end of the day, when it comes to federal tax burden, 2 people, one in Texas and one in New York, that make the exact same amount of money, I don't think they should be paying a wildly different federal tax. I think they should be paying totally different state taxes based on what it is that is going on in each state and how each state chooses to generate revenue. But one state should not create a lower federal tax burden versus another, in my opinion.
Great, thank you. David, everybody who's interested in the economy has to figure out what to read and look at to know what's going on. Tell people why the Dividend Cafe, which you write daily, is something you think that they should make time for.
I think that Dividend Cafe is my attempt to be objective. I do implement some of my own political views or thoughts on policy, but I do so with, first of all, in the spirit of two-way. There is a sort of peace, love, and understanding. I want there to be civility in my discourse. I may fail in that sometimes, but I hope I don't. But it is meant to provide an objectivity in terms of an economic perspective with real investment application, and yet still connected to the world of policy and monetary policy, what the central bank, Federal Reserve is doing. So it is, I think, a really great resource. It was born out of the financial crisis. I began writing it every single Friday in September of 2008, the week that Lehman Brothers went down. And since then, I've just increased the frequency and the scope and magnitude. And I guess I'm blessed to say the readers have increased quite a bit as well. But that's all it is. It's a free resource that I wrote for clients. And now we happen to have an awful lot of non-clients who read it. But if there wasn't a single non-client who read it, I would still be writing it every week, just as sharing my thought leadership and intellectual capital with our clients. And we invite others to participate in that perspective. They probably won't agree all the time, but I do think it's good information. And I do believe that a lot of people's investment application, the information they get on how to think about the economy connected to investments, I think it's generally through the lens of the financial media that has a business model which requires it to be sensationalistic. I have a business model that has no opinion on sensationalism whatsoever. There's no point in me using Dividend Cafe to tell you that the market's going to be up next week or down next week. I have a business model that is incentivizing me to tell the truth, which is I don't have any idea what the market's going to do next week. And neither does the person on CNBC giving a 3-day prediction or 3-hour prediction. Big hype on things falling apart or big euphoria on things running up. We don't do a lot of that in Dividend Cafe. And that speaks to, I think, a more sensible and thoughtful approach than you might get sometimes in more mainstream financial media.
Yeah. I'd like to announce a special offer to two-way community members to receive Dividend Cafe at a special price. But as David said, it's free. Tell folks if they want to get Dividend Cafe or if they want to learn more about the Bahnsen Group, where they should go.
Yeah, so I think Mark has a link at the two-way website.
Two-way.tv/TBG, the Bahnsen Group, is one way to get to both the newsletter and the website.
And if you want to remember the URL, dividendcafe.com, then that will get you to the website, and as well as the ability to see a lot more information about our company and our approach to wealth management and all of that. Dividendcafe.com, the two-way site, will get you there. And you can subscribe and, of course, unsubscribe at any time. But that's how you find us, Mark.
Yeah. And if you're interested in potentially becoming a client of David's, if you think his economic insight is worthy of consideration for him to help manage your wealth, you can find him through Dividend Cafe as well. Couldn't be more grateful to you, David, for spending more time with us and for your sponsorship at Two-Way tonight. And we'll talk more in the near future. I hope everybody has a great day, and I'll see you at 6 p.m. Eastern Time for Two-Way tonight, sponsored by the Bahnsen Group, and 4 o'clock, Michael Moynihan's program is on as well. Thank you, everybody. David, thank you. Great to see you.